Gold just hit its most overbought level in history, and that usually means one thing. A big move is coming, but which way? In this week's Commodity Corner, we're breaking down gold, silver, platinum, oil, natural gas, and cocoa, giving you the insights you need in order to prepare for the upcoming trading week. Let's start with gold because what's happening here could be the spark that sets the tone for every other metal market this week. Over the past few sessions, we've seen gold push into extreme territory on multiple indicators, RSI, momentum, you name it. Gold has been unstoppable as it's pushing to fresh new highs. The big question now is, are we about to see a sharp pullback? But here's what gets really interesting. Despite the strength and with the momentum indicators flashing red due to being at extreme overbought levels, the market could still continue to power forward. Central banks are still the biggest holders and they are not selling it, as well as China, which has been stockpiling gold. Let's get into the technicals. To start with a disclaimer, gold was very difficult this week. I don't care who you are, trader, investor, gold was really difficult. You had some wacky overnight moves that got negated. Then you had some weird intraday moves that got negated during Globex and vice versa. It was really, really difficult. Gold was not an easy place to be this week, whether it had been gold, silver, or platinum, which we're going to get into later on. But the metals were extremely difficult this week. There have been calls for 5,000, 10,000 in gold. To be honest with you, we believe that's a fool's errand. Control what you can control. Everything else is just noise. Wherever the market's going to go, it's going to go. When you look at the technical picture, we did have an inside day on Friday. Now, is the market due for a pullback? Sure. But like we mentioned in the beginning, with central banks being the biggest holders, as well as China stockpiling, we don't believe there's going to be massive pullbacks here because they're just not going to be selling. We feel maybe the market potentially comes into about 4,100, maybe, or it chops around over here, around this 42, 4,150, $4,200 area, burns off some of those oversold conditions through time, not necessarily through price, but through time. We want to put this disclaimer out there as well. That is the biggest fallacy in trading. Price is as important. Time is what matters more. It's price in relation to time. So just keep that in mind that the market could consolidate, chop around for a week or two, or even a few days, whatever it is, burn off some of those oversold conditions and then continue forward. So we don't believe there's any reason to be short this market at all. We do believe if you're going to be buying up here, you need to be cautious. Just understand that you're buying it as a trader, not as an investor. As a trader, you're buying it at all-time highs when it's had a massive, massive run. Let's go just quickly to a monthly. You're basically buying it like the worst possible spot. If you're a trader, if you're an investor buying physical gold, you own the asset, so it's a different story. This is catered towards traders. Traders, if you're looking to buy this to hold for a swing, you're asking for trouble. You need to wait for retracements where you can manage risk, especially in the future space. If you're looking to hold on to this for 5,000, or if that's your price target that you're looking for, with rolls and everything that happens overnight, you're asking for trouble. So you really need to be keenly aware of where you're getting in, why you're getting in, and where your stop is. And more importantly, your stop needs to be where you're wrong, not where you're losing money. Stops are not designed for that. Stops are to tell you when you are wrong. Gold looks great. It's still looking, we've used this word a lot, amazing. There's really no other way to say this. The weekly, it looks fantastic. The monthly, it looks fantastic. The daily, it looks fantastic. Again, it is definitely overbought, and retracement is probably going to be coming, but we believe that they're going to be shallow because the only way that this asset gets creamed is if central banks start selling all their gold, and we don't believe that's even remotely in the cards. So for now, the trade is long, just find appropriate spots to be long. Either way, the next move in gold probably will set the tone for the remainder of the metals space, especially when it comes to silver and platinum. We believe that gold really sets the tone. Let's get into silver. We usually start silver on this monthly, so we're just going to continue with that as well. All we can say is, wow, what a move. This is pretty much one of those moves where not only do you stand up and take notice, but it pretty much just knocks your socks off. This move in silver has been nothing short of epic. There's no other word that you could possibly use to describe what's going on in silver. One thing we'll mention is that every one of our targets was taken out and was taken out with ease. We do find ourselves now, obviously silver made new all-time highs. We do have somewhat of a quasi triple top. The market hasn't backed off enough yet to say that it is a triple top. We've seen calls for $100 silver. We don't believe that that's going to be in the cards. We believe that the market's going to do what the market's going to do. We're not going to put on a price target because we think that's a fool's errand, plain and simple. So let's just get into what's going on. As we mentioned with gold, and we were saying with metals, they've been really difficult. The Globex markets really were making things very difficult for intraday specific traders. And even to hold on to it for swings has been really difficult because you're getting really wacky moves overnight where the markets all of a sudden get creamed, and then you wake up in the morning, come in for the either 820, 825 open, and the markets are green, or they're going from red to green, and they were down huge, but now they're recovered. So they've been really difficult. So you really have to honor your stops here. You really have to be careful. Silver follows the same thing as gold does in terms of the trend. The trend is obviously up. It's parabolic. You can see it. But again, price really is not the determining factor here now. It's going to be time. What does the market do here? We think that the market may pull into this $48 zone, and we think that might be a good spot to start nibbling into longs. We think that 49 probably doesn't hold. It might get into this 48 and maybe even shake the tree a little bit more and come down to 47. We don't think epic crashes are coming down. There's no reason to believe that that's even remotely in the cards. One thing we want to bring out, we brought it up last week. We want to bring it out again. It's going to be a recurring theme. If you are a gold and silver trader and you're trading the futures, you need to pay attention to the 9:30 U.S. equity market open. When the GLD and the SLV open, you need to pay attention to it. The reason being is because at 9:30, all of a sudden, the complexion that was going on when these markets open, gold at 820 and silver at 825, changes, and it changes very drastically. So you need to be aware of what the ETFs are doing. Right now, everybody is trading GLD and SLV in the equity space. You need to pay attention to it because it is definitely changing the complexion of the day. And if the market was, let's say, long, and all of a sudden the GLD and SLV holders decide that they want to start selling out a little bit, all of a sudden the markets start dumping. And vice versa. If the markets were going down and they decide they want to start buying, all of a sudden the markets start rip roaring. You really need to pay attention to them. They're crucial right now. But silver's still looking good. Nothing really there that to get alarmed about. Trend is up, so just go with it. Let's get into platinum. Platinum's interesting because platinum is actually the market that's relatively lagging. Gold and silver are powering through. Platinum really took it on the chin on Friday. It was definitely a stand up and take notice day. But let's just stick on the monthly for right now. Obviously, target 1 got hit. Target 2 got hit. Target 3 is up here at this 1900 area, 1920-ish area. We do believe the market will hit it. We do believe the market's probably going to get to 2000. Just for reference, the target of 1750-ish area that got hit this week was the February 2013 highs. We took that out. Now we're looking for the August 2011 high, which is 1850. We think the market's going to get there. We think the market's probably going to get to 2000, and then we'll see where it goes from there. But we do believe that this is a viable target. The problem with platinum over gold and silver, just to understand it, is that it doesn't have the liquidity that gold and silver do. So because of that reason, the moves are more dramatic because the participation in those markets is not the same. So it's something you need to be aware of. When you're looking at intraday charts of platinum, you do need to a large extent put your stop in it and forget about it. The reason being is because if you look at it intraday when it's moving around, the chart itself can get you out because it has these wicked counter trend moves that really amount to nothing. But let's say, for example, you bought 1600 and you put a stop at, let's say, 1580. The market gets up to 1640 and all of a sudden starts falling down to 1620, 1615. That move, when you're watching it on an intraday basis, could shake you out of the market when really nothing's going on. And then the market stabilizes 1615, finds a quote unquote bottom, and then takes out the highs. And meanwhile, you got shooken out of the trade because of the nature of the liquidity and the volume in platinum. So you do need to be a little bit more careful with it. It's one of those things where we would advise not watching it. If you're going to get in, put your stop and don't even think about it. And just wherever you believe you want to get out, then just put your order out and finish. But don't sit and watch it on an intraday basis, because you will get shooken out by these shake the tree style moves that platinum does do. However, when platinum gets going, and we've said this numerous times with other commodities, and it's a characteristic of commodity markets in general, when commodities go, they just go. So when you look at gold, you look at silver, you look at platinum, when they go, they just go. Even oil, every commodity, when they go, they go. They don't revert to the mean necessarily. When they're breaking out and they're ripping, don't get in front of it. Stay with the trend or get out of the way, but don't try and fight it, because you will get hurt. Okay. So platinum's, it's holding where it needs to. We don't see any reason why you should be out of this. We think the market came back into this zone. We think this is going to hold. Maybe we shake the tree a little bit more and get down to 1570 to 1580. We don't think that's going to really happen unless, again, something changes. But for now, we believe the trend is up. We don't see any reason to not be long this market. We think that, going back to the monthly, we think that this 1920 area, 1918 high is going to get taken. We think the market's going to get to 2000. We think that's just ultimately where it's going to go. However, disclaimer, if gold and silver fall out of bed for whatever reason, then all bets are off on platinum, and then it's going to come in and you're going to have to find a better spot. So then your next spot to buy it is around 1550 if you're looking for that $2,000 target. Okay. Let's move on to oil. Let's just say it like it is. The market broke 60, tried one day to try and reclaim it, couldn't, and now we're in that 55 to 60 zone. Ultimately, we think the target area is 55.30, 55.12. We think these lows are going to get taken out. Do we fall much harder than that? We'll have to see. Oil is facing two problems, and we'll get into the technicals in a second, but oil is facing two problems. One, demand is not there. And we've been talking about it for weeks and months, that when the market was trading in the high 60s and poking above 70, the move made no sense because the demand is not there. Supply is increasing. The supply and demand dynamic at play is one aspect. The second aspect, which is the way we look at oil a lot of times, especially in moves like this, is that oil is the lifeblood of the global economy. If oil prices are falling, that's telling you something. So oil trading sub 60 and living now 57.5, but living basically in that 60 to 55 zone for right now is telling you something. It's telling you the global engine is slowing down. So because of that reason, it's forecasting recession. Now, is it going to be a mild recession? Who knows? Could it be a false indicator and the global economy does not go into recession? Possible. Anything is possible. Even though company earnings are doing well and companies are still making money, at the end of the day, if the global engine is slowing down, which is what oil is forecasting right now, it doesn't matter if these companies are making money, because they can be making money this quarter, next quarter, they might not be making as much. So all of a sudden, analyst estimates come down because company earnings are not as strong as they were the quarter before that. Why we bring this up is it's important to not live in just a technical bubble of oil and say, well, we have a trend line over here and we're holding the trend line and we have it almost like a channel and we're holding this channel. If the market gets down to the bottom of the channel, which it did, then it should bounce back up the other channel, the other side of the channel. Is that a technical fallacy? No, it's not. But at the same time, it's very important to always remember these are just tools. So the markets can go wherever they want. Because of that reason, there are other pieces of data that you need to be aware of in order to formulate your trading decisions, understand what's going on. The market is going down. Should you be looking to step in front and buy it? Right now, if the trend is down, why would you do that for? However, with that being said, can you get counter trend moves and trade the channel? 100%. But just be aware of where you are wrong and where you are getting out if you're wrong. Let markets settle in. If you're looking to buy it, if you're looking to sell it, then it's very simple. Rips can be sold. At this point in time, the market's down. So there's really no reason, and the market's going down and the trend is lower. So there's no real reason to think any reason right now why the market should not continue lower. Now we are coming into that $55 zone, which are the April 25 lows. Could the market make a new low on the year? Why not? But we do believe that the market probably is going to be contained in the 55 to 60 zone. That's where we are right now. So we think that's where the market will be contained unless something drastic happens that obviously none of us can forecast. But we think the market now basically lives in that 55 to 60 zone, which makes it a little bit more predictable. So obviously you can sell rips and then you can buy dips, but you got to be very careful with what you're buying and honor your stops no matter what. All right, let's get to natural gas. We're just going to say it outright. We were wrong. Our original thesis was that the market would hold $3.10 and vacillate between 310 and 350. We were wrong. The market broke through it. The market got down to 290 and we were wrong. But the question becomes, why were we wrong? Leaving the technical picture outside, because when you look at it from a technical perspective, realistically, this 310 probably should have held. Horizontal support levels are usually more powerful and tend to hold more than diagonal support levels do, just because when you have a horizontal support, you usually have multiple touches. So you had resistance 1, resistance 2, we get above it, as the old adage is, support becomes resistance, resistance becomes support. So this was 2 times we had resistance here, came in, this should have held, it didn't, we broke through it, okay? You could use a diagonal. We don't think this is as powerful. We don't think that this is going to hold from a technical picture. The market could do whatever it's going to do, but in terms of just horizontal versus diagonal, we feel that horizontal is better. It has more power to it and more control in terms of from technically if the market's going to hold or not. One thing we want to put out is when you're drawing these lines and moving averages and whatever you're using, keep in mind that they're for you. And if the market needs to go somewhere and somebody needs to do something, they're going to do it regardless of your lines. So just keep that in mind that they're references for you and for you only. Another thing we always like to point out is if everybody can see it and everybody can do it, then it probably won't work. That doesn't mean that every single time it doesn't work, but usually when the masses can see it and the masses can do it, it usually doesn't work. However, with that being said, why were we wrong? The reason why we went wrong in natural gas is that the anticipation was that weather would get colder. Therefore, there would start to be less inventory being injected into the ground. There'll be a little bit more drawing happening, and that's not happening. Weather models now are forecasting that it's going to be a little bit milder than people originally anticipated. We are getting into the back end of October, and it's not cold. And when we say not cold, it's not cold where you're going to have increased natural gas demand from heat. So because of that reason, the market continues to go lower. We don't believe that this low is going to get taken out. We just think that the band and the zone is probably expanded for now. Obviously, this 280 is a reference for us. We don't believe it's going to get taken out. That doesn't mean it can't. However, we will say we are pretty confident that this low from August of 2.622 is not going to get taken out. We think this is a secure low. We just think the market's probably going to vacillate and live in a range of about 280 to about 330-ish is where we think the market's going to be. We were originally thinking that maybe the market gets up to $4. We don't think that that's going to happen now. We think the market pretty much may have seen its high area. So even if we get cold snaps, maybe we get up to 370, 380, maybe we'll push $4. But because of the fact that we have so much inventory, we think the market's basically going to live somewhere around here, which makes it tradable, but makes it more difficult. So you really need to be paying attention to those Thursday inventory numbers. They're really crucial now because that's really going to dictate where this thing goes. And if you have the ability to check weather forecasts, we would advise doing it just to see if there is a cold streak coming throughout the country so that you can forecast that demand is going to go up just because it's getting colder. That's the way we would play it. But we would be a little bit more careful with this market now just because inventories are at record levels, as well as weather is not really being in its favor. Finally, let's wrap it up with cocoa. So in the past week, the market had a quasi inside week. This target zone that we have of about 5,300, 5,400 is still in play. This market's been very volatile. It was volatile a couple of years ago, and it's been volatile pretty much this entire year. The volatility is pretty awesome in this. However, one thing we want to put out there is that volume and liquidity are really non-existent here. So you really have to be careful with it just because of the fact that participation is a little bit lower. So just keep that in mind. But the market looks good on the downside. The trend still continues. Could there be a counter trend move? Let's look quickly at the daily. Could there be a counter trend move? You had your counter trend move. Could the market bounce up to 64? Potentially. We don't think so, though. We think that the market's probably heading down to this target area of about 53, 5,400. Either way, cocoa remains a market where volatility is in trend, and traders should stay nimble heading into next week. Thanks for watching, and we'll see you on the next one.